that's part of, we want to make sure that you actually get a proper portfolio here. So also, if you go off and do it by yourself, there are some common mistakes that a lot of amateur investors make. A lot of it is around market timing, chasing returns. So whenever you buy whatever's been going up recently, if your investments go down, or you sell it, let's switch over to something else. And that market timing. So studies consistently show that the average investment, the average do-it-yourselfer makes quite a bit less than the market overall. And so most professional advisors and make less than the index, for example, but the do-it-yourselfers on average make even less than that. And let's say, so studies say, for example, that maybe lose 3% per year average over your lifetime by making these common amateur investing mistakes. So if we're looking after the investments, we're there to help you. The other really, really big one is the panic in a down market. So if only once in the next 30 years, the market crashes and you panic and sell, you've lost a whole ton of your lifetime return. So you may have lost, 30 or 40% because you sold at the bottom and you claimed that loss and took a long time to get back in. And that's, even divided by 30 years, that's 1 or 2%. That's a huge amount effect of your overall plan over the long term. And it's not because you sold, it's not something that you get back. Okay. So we've had some clients where they were kind of panicking. They call us up and we just talk them down off the ledge. And remember, you're in a long-term plan. These are high quality investments, and we just help them stay invested. And that alone is really hugely valuable. So you can think of working with us with the investments as insurance against you doing something stupid. So I find a lot of people that are doing some investing wherever they are with an advisor, or even quite a few on their own, and they just feel comfortable with whatever they're doing. So they wouldn't want to work with us full service because they want to control their own investments. But with us, you still see that you see what all the investments are, and we're there to help you avoid making the common mistakes, and we're there to make sure you get the top quality investments that actually also that also fit in with your plan. And just think of it as insurance against you doing something stupid. So now one of the questions I got was, how can I be unbiased? If we're offering full service and we're doing the investments, how can we still be unbiased? So that's what actually gave that a lot of thought. And there are 3 key principles for being unbiased when you're looking after investments. So first one is we get the same fee regardless of any of the investments. Okay, so we found a couple of top portfolio managers. They do all the investing for us. We get exactly the same fee, regardless of which portfolio manager or what portfolio you get. Our fee is exactly the same. So we're not biased in any way. We just want to make sure that you get at the end of these portfolio managers are kind of the elite investor. They can buy anything, basically anything that's out there, so they can design the custom thing that's there for you. And we also are there to see it, make sure that it fits with your plan, and also we have investment knowledge too. We just want to make sure that we think it's a good strategy and all of what they're doing. But basically, but we get the same fee regardless of what you do. So now none of the investments are provided by our company. So our company is actually called Oakland Enterprise is just our financial planning firm. So I have a company called Unconventional Wisdom that does write the plan initially and does the blog, and then we have Oakland that looks after the full service clients. That's our company, but our portfolio managers are separate companies. They pay us a referral fee for referring you clients, okay? But none of them are for us, so we're not biased to. They could, whatever investment they want to get is that's kind of up to their choice. So, and we have 2 portfolio managers. One's called the All-Star Fund Managers. So the portfolio manager is just trying to find the world's best investors. The other one's called Index Plus. So basically it's an index type strategy, but he's paid mainly based on beating the index. So his fee is mainly based on how much he beats the index. So think of it like an index fund or ETF, except that you have a really good chance of getting above index return. Of course, if you buy an index fund or ETF, you're going to get, the index minus a little bit. So, right. So especially if you're a global investment, which what most people should be, If you buy a global ETF, your total return after everything is going to be maybe 0.5% a year lower than the index. Well, we're trying to do better than that. So now I can tell you, so I've done our research on these, and we actually believe in these guys. And so I can tell you, so my personal investments, 100% of my personal investments are with our all-star fund manager portfolio managers. So they've actually been doing better than the other ones. Some people just feel comfortable with indexing, so we have that as an option. But the all-star fund managers, there's some really amazing fund managers out there. It's actually really cool to watch them. And I can tell you, I have 100% of my personal investments with the same portfolio manager and the same all-star fund managers that we recommend for our clients. So we genuinely believe that they're the right thing. It doesn't mean we're right, but we're taking you, we're trying to guide you to what we think is the really best way to be able to go. So then, the last question is the benefit of our fees, of our services, more than the cost? Okay, so and again, there's two of them. One is for the financial plan, and one is the ongoing full service. So, all right, so so they need to be, so the fees need to be worthwhile, and that's part of, when you contact us first for a free 30-minute consultation, that's the purpose of that call. So we try to get a sense of what's important to you. What is it that you're missing in your life? What advice do you need? And then we're looking at, is this going to be beneficial for you to be able to work together? And that's basically what the decision is. Are we a good fit to work together? So we only take you on if we believe from the beginning, and you believe also that this is going to be worthwhile. So, and the full service fee, that's the one-time financial plan, and the benefit there is, as I said before, it's of having a financial plan. It's way bigger than you think. So for our clients that have been with us for a while and look back on the financial plan, like their life took a different direction once they had a financial plan and they knew where they're going. The benefit is just hugely beneficial from them, and they saw the net worth and everything take off from that point. So, and the ongoing full service investment fee. So now we try to pay for that, for our ongoing fee, entirely by recommending superior investments. Okay, so we think we've got this. We're trying to provide the very highest quality financial planning advice. However, we try to pay for ourselves entirely by having our portfolio managers outperform the indexes after all fees, including ours. And if they do that, then we think we've kind of paid for ourselves. So, for example, you could go out yourself and just buy an index fund, okay? But working with us, we would expect that your returns would be higher than that after all fees and including ours. So therefore, we haven't really cost you anything. If we can do that, we haven't really cost you anything. And all of our advice, highest quality of advice, and it's all just purely value added. So that's what we're trying to do. And that's what we've been actually able to achieve for our clients. So yeah, so now these portfolio managers, they have long-term track records ahead of the indexes. And the all-star fund manager has, he's investing with a few all-star fund managers that all have very long-term track records, 15-year to 30-year, that are above the indexes after all fees. And they believe this is skill. And so we believe that over time they should be able to continue to outperform. Now, they don't necessarily beat it every year, but over time we're very confident that we should be able to outperform the indexes after all fees. So that's why we call our investing approach above index investing. So, generally just buying index fund is below index return investing, because you're going to get return of the index minus something. We're trying to be somewhere above that. So now, how have our portfolio managers performed? Have they actually have the returns actually been better than the index after fees? Well, let me show you. So this fund is the All-Star Fund Manager Portfolio Manager. And first of all, I just want to show you the good and the bad so you get a sense of where it is. So we've been working with them about 4 years, but their underlying fund managers are way longer than that. And so in the growth markets, remember, so the last several years, the market's been going like pretty well straight up until the end of last year. And this entire year, it's been basically down. So what actually happens in those areas? So this was up until the end of last year. from when we started working with them, these returns, so the blue is our client's return, and that, again, that's after all fees, including ours. The red is the index, and that's not the what an index fund will make, that's the actual index with no fees. So our clients average 19.9 versus 16.5 for the index, so 3.4% per year ahead of the index, and that's what we're like in a growth market. So now, this is what it is up the most recent one. So this is the market's been going straight down. And this is September. So actually the last 2 months, October, November, the market's been going up again. So this is, now we've picked from the top to the bottom. It's probably the monthly bottom in this decline. And you notice that we actually declined more than the market, but overall, since the beginning, we're up 7.2 versus the index 7.1. So we're still ahead of the index since as long as we've been working with this portfolio manager. And in general, this is kind of the main portfolio that probably most of our clients are using. And what you generally see is it's going more than the index in both directions. And since the market is going up most of the time, that's why we expect to beat it over time. So when it's going up, we're generally outperforming. When it's going down, we may go down a little bit more, but over time it works out for you. So, all right, so that's the All-Star Portfolio Manager. Now, this is the Index Plus one. I just want to show you what this is. So this one, and here what happens is you've got different mandates to choose. So you Canadian, US, international, or emerging markets. And so they've designed it based on all that. They could also do a global one. They have all this, but I just want to show you the individual mandates because that's how they track it. So these are time periods, but let's take the longer term time period. Now this block, just so you what it is, this is a list of all the portfolio managers available in Canada. And what they've done is they've knocked off the bottom 5% and the top 5%. So this is kind of the bulk of them, the middle 90% of portfolio managers. The green is the index, and the blue is their performance. So this one here, I actually got to be able to see this: 10 years, 10.1 versus 7.7 for the index. That's the long-term return. Now, see, this year was actually lost a bit more in the Canadian one, but there it's the same as the index, and it's been above with a little bit longer period of time. So that's Canadian. Now this one part, look at this one. This is the US. So again, we're above the index. The US one's actually the hardest one to beat, but above the index over time. And this year, basically exactly the same as the index. This is the international one, and so basically the developed world outside of North America, and again ahead of the index here, it's 11.2 versus 9.8. And this is the emerging markets. This one's actually quite neat. It's actually you see a big difference there of 13.9 versus 7.1. A big difference. I mean, the emerging markets is so diversified that there's much more opportunity to be able to outperform by reallocating differently than the index is just everywhere. While you can do something quite differently. Planning for it effectively. So, all right, so you see both portfolio managers have been outperforming the index after all fees, including ours, and we expect that should continue over time. So now these are the main portfolios. Okay, see, these are the main portfolios. So when you go to the portfolio manager, there's different risk levels, and you may have different ones. But most of our clients tend to be growth-focused people, and they're we're trying to get a higher rate of return, and most of our clients are 100% equities, and a lot of them are doing leverage strategies or whatever. They're more growth-focused people, and this is kind of the portfolio that most of them have, and that's why I'm showing you this portfolio. Of course, if you're much more conservative, then having the entire index as as your benchmark is probably not right. You should have a benchmark that fits the way that you're going. But this is if you're a 100% equity person, we're comparing it to the equity index. Okay, so this is what we learned today. We learned why a financial plan is the most effective for you, and you need to start with one. We learned when you should get your financial plan, the benefits of fee-for-service financial plans, so you see what they are, and the difference between fee-for-service and fee only. And also you can see why we offer the full service the way we do it. So why we do only those two financial plans and full service, and we think this is the highest quality financial planning advice. We designed it to be that way. And if it's not, we're always trying to figure out what is the highest quality advice that we could do. That's what we're trying to be. We're there all year with you, working with you to make sure that you achieve the life that you want to have. So how can full service with portfolio management be unbiased? So you saw our 3 key principles of that. You saw how our portfolio managers performed, and you can see that our fees should definitely be worthwhile for you, especially if we can cover the ball with investment management. Our ongoing advice at the highest quality level of advice is all just purely value added. All right, so thanks a lot for listening today. Again, my name is Ed Rempel. My blog is Unconventional Wisdom. It's the #1 blog in Canada for a financial planner. It's under edrempel.com. And if you go to that site, you can just hit contact and you can request a free 30-minute consultation. And the only purpose is to see what are you trying to do and are we a fit to be able to work together. So, and also please like and subscribe. I have a blog and a YouTube channel. And if you like and subscribe to them, all that means is we will send you, whenever I do a new video or a new article, you'll get it sent to your, directly to your email. I'm trying to do one every Thursday. So yeah, you'll just get it directly to your email instead of having to go search for it. So thanks again for listening, and we'll talk to you next week.